Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Chinese tech shares and U.S. futures get a boost as Nvidia says it will resume sales of its H20 AI chip to China after receiving U.S. assurances on export licenses. We'll ask closely watch tech investor Daniel Niles why he sees Nvidia and Microsoft leading the charge in equities, even as warning signs build heading into year-end. Meanwhile, China's second quarter economic growth exceeds expectations, helped by strong exports to countries other than the U.S. But Beijing finds domestic consumers to be a tough crowd. And as Trump's tariff tactics sow confusion and chaos among trade negotiators, we unpack the strategy with former APEC chief Bollard. It's looking pretty muted when it comes to Asian stocks, wavering somewhat between gains and losses on Trump's tariff comments and ahead of U.S. CPI data. Also ahead of earnings season, investors waiting to see if companies are revising their forecasts on the back of tariffs. We're keeping a close watch on the SET. It is in focus after Reuters reported that Thailand's finance minister will propose Vitai Ratanakorn as the BOT chief. Taking a look where we are in terms of the MSCI Asia Pac Index, up 0.1%. Also in focus in Japan, JGB's Japan 10-year yield rising to the highest since 2008. 20 and 30-year yields also rising to the highest since 1999. It is a reminder that it's not just those super long bonds under pressure, not just about 20 and 40s, also about the 10s. And of course, we're keeping an eye on China. China's economic growth exceeded Beijing's full-year target in the second quarter at 5.2%. Strong exports to markets outside the U.S., offsetting pressure caused by Trump tariffs. Meantime, the Chinex and Hang Seng Tech indexes are higher today after traveling sideways for the past 2 months. That's after Nvidia said it plans to resume sales of its H20 AI accelerator to China on assurances from the U.S. government that it would be granted licenses. And meanwhile, U.S. tech stocks have also seen a strong rebound, with Bloomberg's Magnificent 7 index climbing nearly 40% from its April lows. The index is also inching towards an all-time high set in December last year, just as the latest earnings season gets underway in the U.S. Well, joining us now, renowned tech investor Daniel Niles, founder of Niles Investment Management. He's been a portfolio manager for more than 20 years. Good to have you with us. I'm just wondering, is it still justify those valuations for tech stocks in the U.S.? We're looking at PE of, what, 40 for the NASDAQ?
Here's the thing. Valuations never matter until you get to a fundamental event that causes them to matter. And unfortunately, with higher retail participation in the markets and also just investors expecting Fed rate cuts, I think what you're going to see is multiples continuing to expand, at least until we get towards that Thanksgiving time period, where I believe the pull-in in demand is going to cause a major problem with estimates being too high, at which point you will have an issue. But in the near term, the valuations, they're definitely high, but as we've seen in the past, they can always go higher when, greed sets in, and we're kind of in that stage right now.
You talk about expectations of rate cuts, Dan. I'm just wondering, how many are you expecting when you take a look at the data? Data has been resilient. I mean, why are you expecting rate cuts when data is pretty strong?
Well, because the Fed wants to cut rates. It's not, this business is never about what you think they should do. Do I think they should cut rates? Absolutely not. Do I think they will cut rates? I absolutely do, because they've told you they want to. And so you combine that with the fact that, don't forget, companies, when they reported Q1 in April, things were still really dicey out there with all the tariff noise. And so the expectations, the guidance was very low for Q2 and the rest of the year. So companies should be able to beat that in the US. In addition, the US dollar averaged about 107 in Q1. It averaged about 100 in Q2. So that's an immediate 7% benefit to international revenues, which are about 40% of the S&P 500. And then don't forget, you've also got demand pull forward because people know prices for high-priced goods like cars or smartphones or PCs are probably going to go up as we get towards the holiday quarter, just as these tariffs kick in. And so there is some pull forward in demand. And so all of those things is going to make Q2 results look very good and probably guidance be okay as well. And that, unfortunately, will probably continue to drive stocks even higher, driving multiples even higher.
The problem is that you're looking at front loading, which means that the second half of the year is going to be pretty problematic. Isn't that true? And if that is true, could we be expecting a correction?
Oh, I'm expecting stocks between Thanksgiving as we approach Thanksgiving through the end of the year. It's not going to surprise me to see a 10 to 20% sell-off in the S&P 500. And in terms of front loading, think about it this way. In Q1, U.S. imports were up 38% year over year within GDP. And GDP of the U.S. is about 1/4 of total global GDP. So there was a massive pull forward at a scale we've never seen before. But here's the thing with investors. They want to believe. And a great example will be what happened in 2021. And you asked me about the Fed. If you remember, inflation started 2021 at 1.4%, which is CPI. It ended the year at 7%. And the Fed told you it was transitory. Investors wanted to believe that. And the S&P was up 27%. So it's that kind of situation I think you're unfortunately in right now where, we're human beings, right? You want to believe, oh, this is real demand. There's no pull forward. There's no benefits from that. But, when you get punched in the face, which I think probably will happen as we get closer to Thanksgiving, because for the big electronics companies, 30 to 35% of revenues for the entire year gets done in the months of November and December. About 15% of that is just done in 5 days between Thanksgiving and Cyber Monday. And so if you bought a PC or cell phone or car, some high-priced good that's going to go up because of tariffs towards the holiday quarter, you're not going to need to buy it again. And I think that's where the issues are going to set in. But for right now, much like in 2021, where investors wanted to believe inflation was transitory, I think that's the case today where investors want to believe this is real demand and not pull forward.
Dan, before we go deeper into the tech plays, I'm just wondering how you square this, right? How can you be bullish when you're expecting a correction of 10 to 20%? I mean, can you be bullish when you're looking at 20% correction?
Well, no, obviously not. What I'm saying is you can be bullish between now and Thanksgiving, right? Stocks can go up quite a bit in a short period of time. If nothing else, you've seen that from April. And especially when you're looking at potential Fed rate cuts before that period, they can continue to levitate. And we're seeing that with the data, right? Over the weekend, for example, you had a whole slew of countries threatened with tariffs going up substantially. What did the stock market do in the US today? It went up. It's near an all-time record high. And so that's kind of what I'm saying. So for every investor who I do this, this is my day job. I'm not, going to a regular job and then having to trade stocks at night. And so I'm looking at all the data. I came into the year negative, as you know, cash was my number one pick. I got bullish in early April because things seemed oversold. And what I'm saying is I think, the party will probably last for a little bit longer, but I'm watching the data every day. And so if the market tells me it's changing and it's looking beyond this near-term euphoria to potentially what could happen, then it's time to start adjusting to that. And what I'm trying to do is give people a roadmap of this is what I think will happen near term, and this is what I think will happen longer term. And based on your risk profile, you can adjust with that. But I've been doing this for a long time, right? As John Maynard Keynes famously said, the market can stay irrational longer than you can remain solvent. And I think the market's going to continue to be irrational in the short term.
It's already been irrational for a very long time. Let's talk about Nvidia, right, Dan? I mean, how long will its party last?
Well, don't forget, its party came to a crashing halt earlier this year. The stock went down 49% from intraday high to intraday low. They had a $4.5 billion write-down. They were restricted from shipping chips into China, which got taken out of all the models. That's a pretty hard crash to the party. We got bullish after they went ahead and took that write-down and said, okay, now finally numbers have been reset enough, and you have inference demand starting to pick up to offset the slowdown you're seeing in training demand. It looks like now Nvidia, with the lobbying they've done to the U.S. government, can start shipping chips into China again. That should help. The multiple is actually not that crazy given the growth rate, which is about 40 times PE. The S&P is at about 24 times, but they should be able to grow revenues at about 20% for the next several years. And compared to some of the other tech stocks that are barely growing, like Apple, that still trade at a high 20s PE, it looks reasonable. And this is all relative, right? But that's why we like Nvidia, because of that big reset we saw earlier in the year. And we've been bullish since.
And of course, that good news you're talking about for Nvidia, that H20 chips resuming to China. Where do you see Nvidia shares trading by year end?
I don't put price targets on companies. Remember what I said, right? I think stocks go up from now till about Thanksgiving. Then they get hit. The market gets hit 10 to 20%. It's hard to imagine Nvidia, when we get there, doesn't also get hit from whatever level it reaches. So that's kind of how I think about things.
You talked earlier about earnings, how you expect earnings to be solid, but that's on the basis that the bar was pretty low. So is it good enough?
Well, we're about to find out this week. I actually, I think I put out a post this morning talking about that, where we're going to have some results coming out soon. Netflix obviously has had a great year so far. The stock has been up on all that optimism. And so you're going to see how the market reacts to what everybody expects is a beat and raise quarter. Same thing with TSMC, especially after this Nvidia news. People are going to be pretty optimistic about it. They report this week, as well as ASML. And then, of course, outside of that, you've got the big banks in the United States like JP Morgan that are also going to report this week. And people are optimistic based on the IPO market reopening, the M&A market heating up, as well as deregulation. And so bank stocks have also done well. And so that's going to give you another clue as to how much more stocks can go up in the near term by seeing, well, how do these stocks react to what people expect are going to be good quarters and good outlooks. And so that's going to give you another hint as to how to think about things going forward.
Do you expect to see a widening of the rally beyond Mag 7 to the S&P?
Well, you've already seen it. You have to remember the Mag 7 in the U.S. is up 4%. The S&P 500 is up 7%. The equal weighted S&P is up more than the Mag 7. So the rally is already broadened. And it's been broadening for a while. And I think you're going to see that continue. And even within the Mag 7, it's not uniform. Let's not forget, you've got 3 stocks that are up, about 20%. Amazon's about flat. And then you've got the other 3 down. Apple down pretty big, Tesla down pretty big, and then you've also got Google down slightly. So, and each one of those is for good fundamental reasons why they're behaving that way. And so I think you're going to see increasing differentiation among the Mag 7 for fundamental reasons, and we can go through that if you'd like, but you've also seen the rally already broadening out, and I think you're going to see that continue going forward.
Given where U.S. stocks are trading right now, valuations being so high, do you see better value in international markets versus the U.S.?
Yeah, I do. And that's why for us, if you look at the performance of the global stock markets, excluding the United States, they're up about 16% year to date. The Magnificent Seven, as I said, are up only 4%, and the S&P is up about 7%. So you've already seen that broadening out occur. And if you're a U.S. investor, the results are absolutely spectacular because you could have invested in the Eurozone ETF, EZU, and be up 26% year to date. So, and this was going on even in April when markets were horrible, where foreign markets were massively outperforming U.S. markets, even though you would think, well, gee, they're getting attacked with all these tariffs. They should be doing worse, and when in fact they were all doing a lot better. And this goes back to what you rightly brought up earlier, which is if you look at valuations in the U.S., when you have CPI between 2.5% to 3%, the trailing PE is normally 19 times. You've got that PE right now trading at 24 times if it were to end the year right now. So you don't have any room there, really, if there is a problem. And so that's why, for me, I'm pretty concerned. And maybe something miraculous will happen. But when you get to Thanksgiving and you have these high expectations for growth in the holiday quarter, if you don't meet it, whereas to your point, a lot of these companies overseas, the valuations are dramatically lower than they are for U.S. stocks. And that's really been the case since ChatGPT came along at the end of 2022 and really supercharged the U.S. markets.
Before I let you go, I'm just wondering, Dan, what are you thinking when it comes to the Chinese market, Indian market? How are you assessing them?
Well, I mean, right now you've obviously got this tariff overhang that's influencing those markets. And in China in particular, you have to look at the fundamentals, which is you have a very severe price war right now being waged between the biggest Chinese companies, between JD, Alibaba, Meituan, in terms of them going after food delivery and instant commerce, et cetera. And so the profit picture there, you're probably going to have some pretty poor results coming out from some of the biggest tech giants. So I don't think you can kind of paint a picture and just say the market as a whole. I think to some degree, much like in the US, there's a big difference between the performance of an Apple computer versus Microsoft, Nvidia, or Meta. I think you have a similar situation in China. But in general, I do like the valuations better. And I think after you get numbers reset, hopefully in China, following Q1 results, a lot of these big tech giants, they have really good AI technology. The problem is that doesn't matter when you're losing a ton of money in your e-commerce business. And so that's what I want to get through, get numbers reset, much like with Nvidia, right? Nvidia stock goes down 49% from peak to trough. Take a big write down. That's when we got very interested, and we talked about it in April. That's kind of how I'm thinking about a lot of the China tech stocks, because as we saw with DeepSeek, there's a lot of good AI technology in China.
Dan, thank you so much for your perspective today. Daniel Niles, founder and portfolio manager at Niles Investment Management. Now, when we come back, a deep dive into China's economic outlook with Fidelity's Peiqian Liu, as the latest data shows growth ahead of Beijing's year-end target. Plus, we'll report live from Mumbai later this hour as Tesla gets ready to open its first showroom in India. Keep it here with us. This is Bloomberg. You're watching Insight. China's latest data shows steadying economic growth, with GDP rising a better than expected 5.2% in the second quarter to exceed Beijing's full-year target. Strong exports are helping offset pressure from President Trump's tariffs as industrial output climbed more than expected in June. Let's get reaction to the latest Chinese economic data with Peiqian Liu, Asia economist at Fidelity International. Peiqian, good to have you with us. We keep talking about how the Chinese economy is showing resilience for now. Is it just a matter of time before it weakens, given the tariff impact?
We have actually received a very interesting set of data today. So to put that into perspective, on the backdrop of China running a dual circulation model, what we've observed so far that the outperformance was really coming from the external circulation. Industrial productions is exceeding expectations, so is net exports. So to your question about are we too focused on now and have been ignoring the future, I think we have really started pivoting since last year. We've seen the September policy pivot in 2024 that the policymakers have decided to pivot a lot more to support domestic demand. Perhaps that takes time. We have seen early signs of stabilization, at least from durable goods consumption perspective, but we do see a lot more work that needs to be done, and that needs to be devoted a lot more to focus on the domestic demand.
Do you see the Chinese government perhaps implementing further measures to boost consumption, or is there a sense of complacency now that there is stability, steady growth as well?
I think it's absolutely needed. And I don't think there's an overcomplacency from that perspective, because we do see a certain amount of stimulus being injected into supporting this consumption sector. So far, we've seen more consumption stimulus injecting into supporting the goods consumption. We do have certain amount of bond issuances that's being allocated and reserved for the second half of the year to stabilize the growth momentum. But what we need to see is more, because we think that the property sector is still at the bottoming phase, and there are more stimulus that's needed to stabilize the sector, so that it injects more confidence into the larger economy, especially the household sector, that will going forward in the future be a major support to China's growth.
So even though we're talking about the need for further stimulus, the urgency, though, has eased somewhat.
I agree, because what we've seen so far, GDP at 5.3% in the first half of the year, is telling us there are certain elements of resilience in China's growth. So that means China could afford to adopt a wait-and-see approach, especially when we see more heightened volatilities on the external environment. I think it perhaps makes sense for the Politburo to assess the economy and signal a lot more flexibility on what's going to happen down the road.
Realistically, what can be expected from the Politburo meeting in July?
I think the Politburo meeting in July will likely to focus a lot more on targeted easing, and most importantly, the elements of flexibility that perhaps is going to inject elements of certainty and confidence into the economy. And the Politburo meeting could be showing the Politburo meeting could be showing their readiness to defend growth targets and coming as needed when external demand start to show more clearer signs of slowing down.
There's a big question mark on the impact of tariffs. When it hits, how badly do you think the numbers will show?
I think the uncertainty is still hanging in the air, so it's very hard to kind of quantify the impact on external demand slowdown to growth. But what we've been observing so far is a more resilient preparation for the tariff that's about to come. One thing that we have observed from the exports data from China's recent releases is that China has been diversifying its export destinations. We did see China's export to the U.S. starting to show slowing down, especially when tariff took effect in April, but overall exports has been stronger than expected. And the underlying reason behind that is China has been making a lot of efforts to diversify. So that means there might be continuing resilience showing in China's exports data.
We know that when it comes to trade negotiation, the U.S. insists on making currency manipulation part of the talks. I'm just wondering what that might mean for the yuan going forward.
It has not yet been a prominent feature of the trade discussions for now, Haslinda. But I think just based on the momentum of China's export resilience, we do see the reason for yuan to become stronger over the next few quarters. And also with a broader weakening dollar environment, it might be the case where the yuan will be stronger against the dollar, but the government officials will be mindful of the yuan's rate against the basket of currencies.
Peiqian, thank you so much for your time today.
My
Peiqian
pleasure.
Liu of Fidelity International. Coming up, America's key trading partners are scrambling for deals while juggling President Trump's fickle temper. We'll talk about those challenges next with former APEC Secretariat Executive Director Alan Bollard. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. President Trump has threatened to impose stiff financial penalties on Russia if it does not end hostilities with Ukraine. He's also promised to send more weapons to Kyiv, including Patriot air defense systems.
But we're very, very unhappy with him, and we're going to be doing very severe tariffs if we don't have a deal in 50 days. tariffs at about 100%. I'm disappointed in President Putin because I thought we would have had a deal 2 months ago, but it doesn't seem to get there. So based on that, we're going to be doing secondary tariffs if we don't have a deal in 50 days. It's very simple. And they'll be at 100%. And that's the way it is.
Bloomberg government editor John Hoskovitz has more. John, what are the implications of Trump's threat of tariffs on Russia, as well as his pledge of weapons for Ukraine?
Sure. I mean, what we're seeing is a significant escalation on the U.S. pressure to get Russia to agree to a ceasefire. The threat of the tariffs is something that we don't have a lot of details on. It's something which really which didn't really rile the oil market. But it comes as the U.S. Senate is also looking at financial punishments on countries that trade in Russian oil as a way to put pressure on Moscow. We have this going on, but the one thing with this tariff threat for Russia is that it could also impact the negotiations that the U.S. has going now with countries such as India, which are one of the main buyers of Russian oil. So we have this financial pressure on one end, and then we have the weapons. These are going to be supplied by NATO. It reduces the U.S. financial responsibility to virtually nothing, but it's something that Ukraine desperately needs. We have air defense systems such as Patriot missiles. We're looking at some drones as well. Ukraine is in this war of attrition. It's been going on for some time. The more weapons they get, the better they are, the better that they can defend themselves. So this will be welcomed by President Zelensky, and it's something which is a way to restore this flow of weapons which had been interrupted during the Trump administration.
John, we're also keeping an eye on the U.S.-EU trade deal. What does the new target list from the EU of U.S. products say about the prospects of the two sides actually reaching a trade deal?
Yeah, it shows that the EU is in this for the long term. They see this as something that's going to be prolonged. They're preparing this list. It's not some sort of brinksmanship. They see a wide array of U.S. products, from Boeing aircraft to chemicals to farm products that are on these things which can be targeted. So the EU is taking a much longer perspective on this, and it comes just the beginning of this month. The EU is looking at some sort of interim deal with the U.S. to accept the baseline rate of 10% and have carve-outs for specific sectors, which would be lower than what the rates are now. So the EU is expanding its list. It's also, we have some reporting from Bloomberg saying that the EU is looking at some countries which it perhaps could seek cooperation to diversify markets and reduce the risk and the exposure that it has to trade with the U.S.
John, thanks so much for that. Bloomberg government editor John Hoskovitz in Tokyo. So far, Trump has kept trade negotiators on edge, constantly changing the rules of the game and shifting deadlines. Recently, he sent letters to countries outlining reciprocal tariffs set to take effect on August 1st. As nations scrambled to strike deals, Trump stunned the EU and Mexico with unexpected 30% tariffs. Brazil, meanwhile, was hit with a 50% tariff last week, with the White House citing its treatment of former President Bolsonaro as a justification. Japan and India, who believe they held the early mover advantage, still remain without any agreements. Meanwhile, Vietnam was completely caught off guard when Trump announced last week it agreed to a 20% tariff rate, which was higher than what it was negotiating. Our next guest is no stranger to trade negotiations. He led the Asia-Pacific Economic Cooperation Secretariat, the world's largest regional body promoting trade, investment, and sustainable economic growth. Alan Bollard was also governor of the Reserve Bank of New Zealand. He's currently a professor at the Wellington School of Business and Government. Dr. Bollard, good to have you with us. It is complicated, isn't it, when you're negotiating a trade deal against a host of demands, including security concerns? Talk to us about how difficult, how challenging this might be for countries.
Well, real trade deals take a long time to negotiate. They take a number of years. They then go through a consultation process, then they go through a legal ratification process, and then they get notified to the World Trade Organization. These things we're hearing about haven't gone through any of those things. They're, I suspect, short-term, unclear deals that probably won't have a very long life on them. So, I mean, it's something entirely different. We used to talk about these trade deals to drive growth. Now they're being used for power. So this is really dark side economics. It's all about finding ways to hurt other economies and protect your own from those. It's in quite a different sort of zone. But it's also been difficult to really unpick all of that as the markets are finding, because the US economy at this time is going through such a strong period of stimulation and has been for a couple of years.
You talked about how trade deals take a very long time, years in fact. We've seen how the deadline has moved again and again. Realistically, how much can be achieved by August 1st?
I think very little can be achieved in that sort of time. And there's a very big question about credibility in all of this, because these things are changing so fast, so often, that I think actually the markets aren't taking them particularly seriously in all of this. And at the same time, for anybody operating in this sort of environment, any traders or government officials, it's a bit like the global financial crisis, like the COVID crisis, when we saw all these uncertainties, all these threats coming down the line. And for a while, you really don't know what's going on. And the safest thing is to do nothing rather than commit yourself to something that might not be there by this time next week.
We know that Trump wants to reshape global trade. From what you have seen so far and the negotiations which are happening right now, how do you see global trade getting reshaped in the next 4 years?
Well, he's reshaping US trade. And that, of course, is big enough that it has implications right through the region. I see what's happening as most of the rest of the world working out ways to insulate them from those shocks. They still want to serve the American market where they can, but they don't want to be subject to these unexpected hikes and barriers as has been happening at the minute. So I think we're seeing in a number of countries a determination to keep doing things, to keep moving towards further trade liberalisation, but understanding it's going to take a long time. It's very difficult. It's under very difficult circumstances. But it's important to signal that we can keep going on those. And so APEC, you mentioned, APEC is this year being hosted in Korea. Pretty hard to see much progress there, especially given the changes in political leadership in Korea. But next year it's hosted in China, and I imagine the Chinese are going to really push to move things, probably along the free trade area for Asia and the Pacific if they can. We're seeing the EU talking to TPP, CPTPP. That's two huge trade blocs. Nothing's going to happen very short term, but it is important to try and keep those sort of things going. China should be talking to TPP. I don't know if they can ever meet the conditions that will be imposed on them, but They should be thinking about it. And we're trying to do that at other levels as well.
And Dr. Bollard, as we speak, we know that Prime Minister Albanese is currently in China to speak with Xi Jinping. This, of course, against the backdrop of wanting more trade between the two countries. China, of course, a very important trading partner for Australia. Talk to us about how this might pan out for the two countries. I mean, the trend of countries looking for alternative trading partners and trading arrangements.
Well, I mean, there's history and there's baggage in that relationship, and I guess both sides are quite keen to put some of that behind them and keep the important trading links going. But for both Australia and New Zealand, China's a hugely important market, but we're both right at the beginning of supply chains. So we're not caught up in a lot of the ASEAN movements around moving productive capacity out of China at the minute. Australia's supplying minerals and gas. New Zealand's supplying dairy and other commodity products. And we expect that to keep going. And I think both countries are following that old British adage of wartime, which is keep calm and carry on.
It is also a delicate balance, isn't it? I mean, give too much and you may face resistance at home. It becomes more and more complicated to make these trade agreements.
Yeah, I mean, a lot of countries like New Zealand are looking internally and saying, do we still have social license to push these areas of further trade? And we're certainly all paying much more attention to who's benefiting and who could be losing from any of these trade deals, and making sure there's ways to cushion the losers, which is something the US did not do, and is now we're seeing the effects of that.
You talked about CPTPP, a 12-member trade organization, and we know that China wants to be a part of that. It's made a bid to be a part of it. You say that CPTPP should engage with China. Why is that?
Well, engage, but not necessarily sign up, because it would put quite distinct requirements on China. We don't want to have a repeat of the WTO situation where there was a lot of enthusiasm to see China join, and then afterwards general feeling that that hadn't entirely worked.
Right.
Joining TPP would put a lot of requirements on the Chinese trade regime, so that would have to be worked through with care.
Dr. Bollard, let's take a listen. We know that Chinese Xi Jinping is speaking right now.
The Chinese side is ready to work with the Australian side to push the bilateral relationship further and make greater progress so as to bring better benefits to our two peoples. I will stop here first. Now over to you.
Well, thank you, Mr. President, and it is my pleasure to meet with you again here today. This is my 8th visit to China, but my 2nd as Prime Minister, and I appreciate very much your hospitality. When Premier Li visited Australia last year for our annual leaders meeting, I was pleased he visited not only Canberra but also Adelaide and Perth. And I know, President Xi, that you have visited every state and territory of Australia. I'm happy to be able to reciprocate Premier Li's visit by visiting 3 cities here in China this week: Shanghai, where I have been, Beijing here, and Chengdu, where I will travel tomorrow afternoon. In Shanghai yesterday, I was very pleased to meet with leading businesses from Australia and China, including important discussions on how we can tackle steel decarbonisation together. In Chengdu tomorrow, I will look at where Australia has growing ties, particularly on medical technology and sports. Tomorrow I'll also visit the Great Wall, where Australia's Prime Minister, Gough Whitlam, who of course initiated the recognition of the People's Republic of China when he came as Labor Party leader in 1971. In Beijing today, I look forward to a constructive annual leaders meeting with Premier Li, identifying opportunities for further practical cooperation in areas of shared interests, including steel decarbonisation. I note your comments in your opening remarks about seeking common ground while sharing differences. That approach has indeed produced very positive benefits for both Australia and for China. The Australian Government welcomes progress on cooperation under the China-Australia Free Trade Agreement, which has its 10th anniversary year. As a direct result, trade is now flowing freely to the benefit of both countries and to people and businesses on both sides, and Australia will remain a strong supporter of free and fair trade. Today also we will have, after this, the Australia-China CEO Roundtable. What that will do is provide a practical example of the benefit of business engagement. Australia values our relationship with China and will continue to approach it in a calm and consistent manner, guided by our national interest, but which we regard very much as a relationship being positive is just that. It is in our national interest and indeed in the interest of the region as well. It's important we have these direct discussions on issues that matter to us and to the stability and prosperity of our region. As you and I have agreed previously, dialogue needs to be at the centre of our relationship, and I welcome the opportunity to set out Australia's views and interests and our thinking on how we can maintain peace, security, stability and prosperity in our region. And I look forward very much to another productive conversation with you today, both at this meeting, and I thank you as well for the honour that you have given myself and Ms Hayden, my fiancée, in the lunch that we will share afterwards as well. Thank you. Shesha.
Australian Prime Minister Anthony Albanese speaking in Beijing, where he is on a visit. He talked about how Australia values China's relationship. Of course, China is Australia's biggest trading partner. He talks about the need for direct talks between the two sides to address key issues, including trade, jobs, and of course, US-China trade tensions as well. Let's get back to Alan Bollard, former executive director at the APEC Secretariat. Dr. Bollard, of course, we saw how Prime Minister Albanese is trying to woo China, establish good relations, straight relations between the two sides. This is an attempt to look at alternative trading arrangements, but we know when it comes to a multilateral arrangement, I mean, no country, not China, not the global south, can replace the role that the US plays in such an arrangement. Isn't that true?
Yeah, I mean, it is true. I must say it was a bit of a relief to see a normal, boring, face-to-face leaders meeting with none of the drama of those White House encounters. And that's exactly what we do need to see to re-establish confidence, to drive these things on the basis of trade rather than a lot of the other drivers that we've seen entering more recently. Yeah, it's a difficult and hard road ahead, and one where the US and US trade is still going to be very important. I mean, one of the issues we will face is that actually US trade as a proportion of their own GDP is not that high. They can get on with contraction in US trade, which is likely to happen. But we all need them. We need other high-income markets, and Australia itself is an important market now as one of the highest-income economies in the world.
Dr. Bollard, in the end, I guess at the end of the 4 years, I'm wondering if trade will be less global, more regional.
Well, my fear is that it could be more imperial, somewhat like at the beginning of World War I, where there were really 3 very big trading blocs, and that was quite problematic. My hope, though, is that it's not the case, and there's a lot of people in a lot of countries working away with these trade negotiations to keep things moving forward so that it does continue to be cross-border, plurilateral, regional and international, even if the US is dropping out of some of the rules of the game and dropping out of some of the important institutions like the WTO. At some stage, they will come back. That's what history tells us.
Dr. Bollard, we appreciate your assessment today. Alan Bollard, former executive director at the APEC Secretariat. Coming up, Tesla is getting ready to open its first Indian showroom on the hunt for new markets to offset slowing growth. We'll be live on the ground in Mumbai next. Keep it here with us. This is Bloomberg. Welcome back. India's been trading for about 5 minutes now. Let's do a check on where it's headed. The Sensex and the other benchmarks in positive territory. That follows 4 days of a losing streak, the longest since March. But some say that the near-term outlook still remains uncertain despite the gains that you're seeing right now. One stock that we're keeping an eye on, HCL Technologies. It is in focus after missing first quarter profit estimates. Now, staying on India, Tesla opening its first India showroom as the EV maker looks towards new markets to offset slowing sales in regions where it's already well established. Bloomberg's India auto reporter Alicia Sachdev joins us live from the new showroom in Mumbai. Alicia, talk to us about how significant this move is.
Well, Well, good morning, Has, and it is a significant move in that after years of back and forth and stop-start negotiations with the Indian government over its high and steep tariffs on car imports, Tesla has finally decided to enter the Indian market. But for PM Modi, who has made local manufacturing the cornerstone of the Indian industrial push, this is not a very satisfying move, given that Tesla is only going to make a bit of a cautious start, a soft landing, if you will, by importing cars into the Indian market to really test the waters first. What we're seeing is Tesla launching with 2 experience centers, one here in Mumbai in the financial capital and one in New Delhi, which is set to open up later this month. So it is significant because it is a milestone, of course, because it is the world's most valuable EV company. India is, although a complex market, too big to ignore. It is the 3rd largest car market in the world. So Tesla has decided to dip its toes. It's not the kind of full-fledged manufacturing push that India was hoping for, but it will allow the brand to really gauge demand for the market, for its cars with the country's affluent buyers.
Weighted debut yet has been pretty low-key. How do you explain the approach that Tesla is taking to a huge market like India?
No, absolutely. It is low-key, especially considering how the other global car makers have approached the Indian market. So we're not really seeing a PR or a media blitz around this launch. There's no Bollywood celebrity cutting a ribbon here. And it is a very Tesla-like playbook. Clearly, it is banking on the organic brand pull that the brand has in other global markets to really do the work in India as well. The best way to look at these experience centers will be as kind of live market experiments. Tesla is about to find out how many people walk into these stores, the kind of buzz that the brand is able to generate, and then how that buzz really translates to people wanting to pony up the cash and pay a very steep premium to actually buy these cars in India.
Big questions being asked right now. What are the key ones for Tesla?
There are 3 big questions that Tesla will have to address in India. The first one, and the one to immediately address, is around pricing. With 70% import tariffs on Tesla's cars, they will fall in an entirely different price bracket than the Tesla cars do in the US and Europe. So one will have to see whether even the luxury car buyers will want to pay these steep premiums for a Tesla badge in India. The second one is really the policy angle. For years, Tesla has tried to negotiate and impress upon India that its car market is highly protected, and particularly for EVs, which is a cleaner emissions technology, there should be concessions given to new players wanting to access the market and gauge demand for their products. India is also currently discussing trade terms with the US and European Union. So if a favorable framework comes up there, then that may change Tesla's plans. And the biggest one, of course, is whether all of this will lead to manufacturing in India, and that's something we'll have to watch for.
Alicia, we have to leave it there. Alicia Sachdev live from Tesla's new showroom in Mumbai. Before we go, here's a quick look at our show tomorrow. Goldman Sachs Chief APAC Regional Equity Strategist Kim Mo will be joining us. Keep it here with us. This is Bloomberg.